Australia is a big country with a small population. We punch above our weight in everything from sport to the arts. And as proud Australians, we prefer to invest our money locally. But for the health of your portfolio, it could be a wise decision to invest some of your money further than our shores, what we like to call going global. Did you know Australian shares represent only 2% of the global market? The size of our market, as in the value of our companies, is tiny on a global scale, especially when compared to trading partners like China and the US. Half of the Australian market is made up of financial companies like the Big Four banks. This means the performance of Australian shares is largely decided by the share price of the banks. And the size of the Australian market means there are limited opportunities for investors in other sectors like healthcare and technology. So, what are we talking about when we say go global? We are talking about investing in some of the biggest and most recognised brands in the world. Apple, Google and Facebook are brands you might use every day. And these are just some of the companies that have had phenomenal growth over the past 5 years. Let's take Apple for example. 10 years ago, the share price was $6.14. Today, it's closing in on $130. A $10,000 investment back in 2005 would now be worth $210,000. This is a tidy 21 times your original amount, or a 35% return every year for 10 years. So how do you invest in these big brands? Well, just because you know the brand names doesn't mean they'll be good businesses to buy. So the best way is to delegate the responsibility to a portfolio manager, either with a managed fund or listed investment company. We call these low-touch investments. The advantage of opting for a manager is they will have a diversified portfolio, manage the exposure to currency and any tax consequences of investing in a particular country. Maybe it's time to look outside Australia and travel the world of investing.